going with the first common strategy that will be used by the option trader. The first common strategy is long call. It's actually an uncovered strategy. You do not have a covering up with another instrument, either from the derivative or from the stock market. So this is actually a long call, buying a right to exercise a call. That's what we call as a long call. And this is the basic of all option strategies. When you are very bullish, so your expectation about the market is very bullish. So what you do is you will buy a long call. So your position is you can exercise it if when you're buying a long call, your expectation is the market price of this particular asset will go in, will increase in future. So you could buy this asset at the strike price, which is much lesser than the future spot price. That's your expectation. So that's why we say that the market expectation is very bullish in nature. And of course, since it is a long call, the risk exposure, the risk is limited to the premium, to your premium, and reward is unlimited. Now, why do we say that reward is unlimited? Because it depends on to what extent the share price had increased. Because if you have fixed your the strike price to be 5,000, and if the market went up, it was very bullish in a 3-month period. If the market went up to 6,000. That's it. So it is unlimited depending upon the movement of the market. Of course, you have a time span, maybe 3 months or 6 months or maybe 1 month or 2 months. Depending upon that, yes, your reward capacities, there is a constraint, that is time period, but the possibilities are unlimited. Anything can happen depending upon the market movement. Now, as we say, the break-even point for this particular person is strike price plus premium. Why? Because he has bought, when he is buying a call, right? He is actually having the he's buying the call at the strike price. So for him, the break price would the break-even point would be the strike price plus the premium which he has paid to the other party who's selling the call. So the person in the short call, right? So he actually when this person is buying this, by paying a premium, that is what we call as we call time value of money, and that is what we call as premium. So strike plus price plus premium would be the break-even point for this person. So he will look up whether the market is above that. Say, for example, yeah, we are coming on with an example in the next slide. So let's discuss. So this is the first strategy, buying a long call. Now here, this is a condition where the underlying asset is Nifty, and currently Nifty is traded at 15,740. So the person is very bullish. So what he is going to do is he is going to, Mr. Jacob is going to buy a call option. So he bought the call option at a strike price of 16,000, which will expire in 3 months. That's a condition. So this is a strategy where he bought. Currently the Nifty is 15,740 as on yesterday's. And yes, he is expecting that the Nifty is going to rise up to 16,000 or above that. His expectation is above that. Okay, definitely, in 3 months' time it will go above that. So that's his expectation. So what he did, he paid a premium of 50 rupees, and he bought it. This is for a convenience. Okay, this premium and all is all decided by the exchange based on different features or different criteria. But now I've just fixed it to make it convenient for you. So the premium is 50. So his break-even point is 16,000 plus 50. That's his break-even point. So he will definitely exercise this if the market is maybe if Nifty is trading at say 16,500 or 16,400 in 3 months' time, when during the expiry. Imagine that this is, of course, in index you can have only European option. So this is a European option, so it can be settled only at the end of the expiry period. So 3 months. So Nifty is trading during that time 16,500. So definitely this person is going to exercise that. and he is going to make a profit. His profit would be the difference between 16,000, no, 50 and 16,500. That's his profit. He got an asset having a value of 16,500 by paying 16,050. So the profit is that difference. So this is the first strategy that can be adopted in a derivative market. It's actually uncovered strategy. There is no covering. Now, the maximum loss to this person can be, suppose if on that day the market was not so bearish after 3 months, okay, September, the market is not so bullish, it is bearish. So the Nifty went down. It went down to say more, maybe 15,500. If that is the case, this person is going to, the maximum amount this person is going to lose is 50 rupees, the premium which is already paid to the person in the short call, the person who has sold the right. So this is the first strategy. I hope that is clear. So the first strategy is nothing but buying a call. So you are in a long call position. Okay, so that is strategy 1. Now we are going with strategy 2. This is also uncovered one. That is short call. So here it's just the opposite. You're very bearish about the market expectation. You expect that the price of the market is going to decrease. So what do? You sell a call. You sell a call, you sell the right, your position is short call. You sell the right to buy to somebody. So naturally, your position will be, if that party exercise, you will have to exercise his right, that is buying a particular script, you will have to really sell it to him. Okay, so your position is short call. So your expectation is, yes, why did you go for it? You knew that the market is going to decrease. So that is why your expectation is bearish, and the risk is unlimited. Why? It depends upon the other party. If the other party decides, say suppose if the price in the market, okay, it went down maybe 10-20% in 3 months time, your loss is to that extent. Because if that is the case, the other person will exercise the call. If the other person exercises the call, you really have to sell it. Suppose if you do not have it, you have to purchase from the market and sell to that person. So that is why we say that the risk is unlimited. And the reward is always limited to the premium which you get when you sell your right, when you sell your call. So that's why we say that the reward is always limited to the premium. That is, you can guess, okay, in short position, always the reward is limited to premium. Nothing more than that. But your expectations are different. That is the difference between a long call and a short call. Now the break-even point here, the break-even point, we will be talking from the buyer's perspective, the person who had gone with long call position. So for buyer, he will be looking at the strike price plus the premium, as we did in the previous case. He will be looking whether the price is above an amount called strike price plus premium. If it is above, he will exercise. If not, he will not exercise. So that is all about short call. So this is strategy 2. This is also uncovered because there is no other protection. If the market goes down, well and good, you are able to, as we say, sell an asset at a better price. And if the market goes up, and the chance that if the market goes down, the chance of other party exercising is very less. Sometimes he may not go with. Why should he buy an asset at a higher cost when it is available in the market at a cheaper price? That may not happen. But in that case, the benefit for the person who take up the short call position will be the premium paid by the other party. And he will be having his asset. So in another 3 months, he can go for selling that in a different contract. Right. So that's it. And this is the exercise which we are going to look at is, yes, it's call option. Right, sell call option. So the strike price, you can see that in this selling, it would be the strike price will be less than the current, normally less than or very near to the current Nifty index. Here also the product is Nifty index, underlying asset is Nifty index. So what this person is expecting, that there is a decrease in the price. So what did he do? He kept the price at a lesser point to make it attractive for the buyers. So there should be somebody who's coming to buy it, but his expectation is the market will go below that. So that is why he went with 15,500. And in this case, the Mr. Jacob is buyer. So he paid to this particular person a premium of 100 rupees. So the break-even point from the other party's perspective is 15,600. From the buyer, that is Jacob's perspective, is 15,600. It goes in, expires in 3 months. So if at all, if no, as you say, if this person is going to make it, if the Nifty is trading above that level, so that person will exercise his deed, his right. In that case, what will be the problem for you is, if you do not own that asset which you have sold, you really have to purchase it from the market and sell it to that person, or you will have to pay the net cash settlement. You are at a loss because you have to pay maybe if the value of Nifty is 50,800. The problem here is you have to sell an asset which costs 15,800 and 15,600 to somebody. So that's actually the loss. You might have got a premium of 100, but you are really in a loss position. So that is the risk which is related to sell call, or as we say, short call. Your risk is unlimited depending upon the action taken by the other party. So this is strategy 2. Strategy 1 is buying a call option. Strategy 2 is selling a call option, right? When you buy a call option, the maximum risk is limited to loss of your premium, but your reward is unlimited. When you sell a call, the maximum reward expected is the premium and risk is unlimited, right? Now the third strategy is called as a long call. Here there is one word which is used before long call. That makes the difference here in strategy 3. That is synthetic long call. It is similar to long call, but this is not actually purely. When we say that, a cotton, it's synthetic cotton. What do we mean by that? There is some mix of, it's not pure cotton, that's it. There is some mix, but it resembles cotton. That's it. So here also, why this is called as synthetic? It resembles long call, but it is not purely long call. Such type of strategy is what we call as synthetic long call. Now here, what happens here is, there are two things that is going to happen. That is, you will buy a stock. Okay, you will buy a stock because you are very bullish about market expectation. You really invested money. Okay, you really invested that money, and then what you have done is you buy a call. You buy a stock. Say the example which I'm going to show you is you buy the shares of ACC. You keep it with you. You expect that the market is going to increase. But at the back end of your mind, you might be having a fear that what happens if the market falls against my expectation? If the market went down against my expectation, what I will do? So because of that fear, what you're going to do is, so this buying a stock is not happening in a derivative market. It happens in a stock market. But because of the fear of the asset value going down, you enter into the derivative market. You engage in long put. You sell. No, what you will do is you engage in another trade where you promise to sell the asset, the same asset, within that stipulated time. So your plan was to invest this asset for a longer period. So you bought ACC shares and you're very bullish about the market. But at the back end, at some part of your mind, you have a feeling that if at all the market is not performing well as per your expectation, you're going to incur loss. Your investment value might come down, right? So because of that, you want to cover up that. This is a covered position. You want to cover up that risk. Now, how do you cover up that? You will enter into the derivative market. You will enter into the derivative market. You will take up a good position. You take up a position to sell the asset at a strike price. What you're going to lose in that? You're going to lose only a premium which you have paid at the time of buying the put. But otherwise, you're facing a situation where your asset value can go down steeply. So you are trying to cover up your risk through something called a synthetic long call. Now we are going to, now the risk is, the maximum risk what you are going to get is your stock price plus the put premium and minus the put strike, means you are going to get it. The strike price you will get it, right? Because you bought the right. So the maximum is the amount you have invested in the stock market plus the premium you have paid to the other party. And reward is unlimited. Why? If the stock goes up, if the stock it went up to greater heights, then you have bought the right. So you can decide that you are not going to sell. What you're going to lose is only the premium. So that's why your reward is unlimited. And the break-even point definitely is put price plus put premium plus stock price minus put strike price. It's nothing but the net result is the net value of strike. You have paid, you have invested in the stock, right? So that you had spent the money. We are going to come up with an example, so it will be very clear to you. And then you bought the strike, you pay the premium, but once you exercise it, you will get the strike price, and so that's your break-even point. We are going to see an exercise for it. It's very simple. So here, what are the two actions? What will be there? You will buy the stock. Initially, you're very bullish about the market. You will buy the stock, and then because of some fear of market not performing as your expectation, you buy a put option from the derivative market. Buying a stock is not happening in a derivative market. It happens in a financial market. You purchase it from on the spot price. But then, in order to cover up the loss of falling this is very common. Okay, people often do that just to cover up that position. Those who know about both stock market and derivative market, they do this synthetic long call. So what they do is they buy the stock, they own the stock in order to cover up the risk of losing the value of the asset. They enter into a derivative market, they buy a put option. So that's what we say, buy stock. See, I have said current market price of ACC is 2050. So you bought one. Not one, actually, it is lot size. But here for our explanation, we have just put one stock. One share of ACC costs 2050. And then you know that there is some problem with the chance of price going down. So what did you do? To make it more attractive, okay, you bought a put. You bought a put at a lesser price, 1,900. And then you paid a premium of 100. So what happened? Literally what happened? If the market is going up, okay, if the market is going up, if the share price went up as you expected to 2,500 or 700, you will not exercise this put option. What maximum you're going to lose is the 100 rupees. The asset is there with you. You will not exercise. You are in a protected position. If the price of the asset went below, that is went below this break-even point. Now, how did we get this break-even point? It is stock price plus the premium, plus the strike price minus the money which you can get. If the break-even point, if it went below 22,150, if it went below, you will think of selling it off to protect yourself. Because sometimes the asset value can go down to zero. Suppose if ACC is being affected with some kind of financial crisis, the asset value can go down maybe 20 to 30 to 40% in a 3 months time. At that time, you can safely sell your asset at the promised price. You can exercise your right to sell it and the other party will be in a position to buy it from you. So the other party is at an unlimited low. So this is actually the third strategy, which is called as synthetic long call. Now, strategy, I have put in red the reason. Strategy looks like a call option. That is call option buy strategy, and therefore it is called a synthetic call. Okay, because here you are more or less you buy it, but there is another strategy you are using it to cover it up. So that's why you call that as a synthetic long call. Okay, right. So, but the first part actually happens in a financial market, and the second part happens in a derivative market to cover up your risk position. This is strategy 3. That the first strategy we said is long call, buying a long call, that is long position. Then second is short call, you're selling your right. Third is synthetic long call, that is you are covering up the position by entering into a derivative market. Then the third strategy which we are going to listen to is long put. Long put is a strategy that a trader will be using when it is plain, it is uncovered. Okay, long put is uncovered strategy. Your loss is unlimited. I mean, your reward is unlimited. Your loss is limited to your long. Always it will be like that. Your reward is unlimited, and your loss, maximum loss, will be to the premium. Because if at all things do not happen as you want, you can exit. What you will lose only will be the premium. Long positions are like that. So that is the fourth strategy. This is uncovered strategy, that is long put. In this trader is very bearish about the market expectation. So what he will do? He will buy a put. He will buy a put because he expects that the asset value will go down further below that. Okay. And then the break-even point, of course, strike price minus the premium which you have paid. Here, the premium which you have paid to obtain this right. Because you're going to get the strike price, maybe you will get 2,000, but actually you are not going to get 2,000. What you are going to get is only 2,000 minus 100 if that 100 rupees is the premium you have paid. So that is long put. We will go with an example. Here also the asset is Nifty. Okay, it's put option, buy put option. So you are in long put. And then you can see that the strike price is 15,500, which is less than the index, because the traders are in a bearish mood. The traders who go with buying a put option are in a bearish expectation. And then the premium is paid to the other party who is selling the right. The break even, of course, I might get 15,500 when I sell my asset, but the actual money I will get is only 15,500 minus the premium I have paid to the other person. So that is what 15,450. It's simple. Now, if the as you say, no, if the asset, okay, if the asset is going above, say, what do you say, if it is going to 50,800 or 900, what you can straight away do is you can exit. You can exit by losing the premium. So that's why the risk exposure is limited. So covering it up is not so essential as in case of short put. Right? That is why this is an uncovered, but your risk is limited. If your risk is limited, still people will go with covering up position by having a mix, which we are going to discuss at later stage. But still at this point, the maximum loss you can expect is your loss of your premium. So that is strategy 4. So we have talked about the first one is the long call, short call, synthetic long call, long put. Now the fifth one which you are going to discuss in our today's class would be short put. Again, the same, it is uncovered. This is also uncovered. What will be coming to your mind is, yes, his loss is unlimited. His reward is limited to premium. Right? And what he expects, okay, this is selling a put. So when he sells his right to sell an asset, he is really into a position of buying if the other party exercise it. Buying the asset if the other party exercise it. Now, he is very bullish about the market expectation. What he expects is the other party is not going to exercise his right because the market is going to be bullish. So he can sell the asset at a higher price in the market, because maybe the asset value of his asset, the value of his assets will go up because the market is bullish. So if if he is put with a condition where this person has to sell the asset at a lower value than what is available in the market, he will not do it. So what this person is expecting is, I will have the premium with me, right? The other party is not going to exercise his right. That's what he is expecting. Or here's another expectation. If at all the other party is going to exercise his right, this market trend is temporary. In the long run, it is going to be bullish. So I have an asset with me, which I have got at a lesser value, but later I can sell it at a higher value. That is his expectation. If at all the other person exercises right by selling the asset, he will purchase it, keep it with him for some time, and then he believes that he can sell that at a higher price. So this is the expectation of a person who is going with short put, and this is an option strategy. Now the risk, put strike price minus put premium. Okay, and this we are talking up from the aspect of selling a put, means limited to the amount of premium, in the sense his reward is limited to the amount of premium, in the sense if this is a case where if the other person is not exercising. If the other person is exercising, if of course in future he can think of, but temporarily his reward is limited to the premium. That's always with respect to short conditions, short positions. And break-even point, of course, from a buyer's perspective, he will always look at strike price minus the premium. When he sells, whatever I'm getting should be reduced from the premium I have paid to the party from whom I have bought the right. So it is from the buyer's perspective, not his perspective, not from a perspective of a person who is taking up the short position. He does not have any say in that. So we need not discuss about his break-even point. Now, we are coming up with an example. Here also, the asset is Nifty. I made it same for you to understand, because I come up with different assets. It might be confusing for you. That's why I kept it like that. And current Nifty index. Here you have the Nifty value to be 15,740. And what happens here is put option. Okay, put option means he is selling the right of put option. So the strike price is 15,500. Okay, it is kept a little below the Nifty because the person who is buying it is having a bearish trend. So definitely the asset value is kept at low, and Mr. Jacob in this case, who is selling the put, gets a premium of 50, and the break-even point from the buyer's perspective would be 15,500 minus 50, that is 15,450. And on the expiry date, if the asset is trading, that is if Nifty is trading in 15,800 or 900, the other person will not exercise, right? If Nifty is trading below 15,450, the other person will exercise the right. And if the other person exercises the right, Mr. Jacob will be buying that and keeping up with that with him. Now, Mr. Jacob is not so depressed. You know why? Because he is very bullish about the market. He believes that maybe this little problem is temporary. Later, he can sell the asset at a higher value in future. So that is his expectation. Sometimes his expectation will come true, sometimes may not. If it is not, he is going to incur huge loss. Because normally when we talk about the index and all, it's not one. This is one unit. There is lot size which will, once you sum up, it will happen in lakhs, maybe more than 2.5 lakhs. So it's not a small investment which you make in derivative market. That's why Mr. Jacob can be in a problem, but he is ready to take up that risk, because if he gains, it will be also a huge amount, maybe 50 to 60,000 in a 3 months period. That's why he's ready to take up that risk. But what you have to remember is this is not a covered position. But the only benefit is he is given with an asset which he can sell at a later stage. So you have to be very careful with what is the underlying asset. Is it something which carries some value? If it is index, he should be okay with, because Nifty index or Nifty is going to perform well today or tomorrow because Indian economy is performing well. Likewise. So this is actually the next strategy which we learned.